Keeping in mind that roughly 75 to 80% of stocks follow the general markets in both directions. If the market's declining or if the market's rising. And that's why knowing the market health and market direction is so important, right? It's imperative to trading on and being on the right side of the market. And indexes are the proxy that I use for that. So my routine always starts on Saturday. So I look at the indexes, like I mentioned, in the state of the market, but I also look at key subsectors. I look at the VIX, I look at breadth, I look at credit spreads, I look at sentiment, and I want to give myself as complete of a picture as possible. Now, there's a lot of different ways to look at each one of these, and I try to define it to as few ways as possible to help decrease the noise. So only the ones that give me the best signals as possible. And sometimes all of these are telling me the same thing. Sometimes they're in conflict. The key is to be objective as possible and read the story the market is telling. All right, so I'm always going to start with S&P 500. And this comes, S&P 500, it's an index composed of selected stocks from 500 issuers, all of which are listed on national stock exchanges and spans over approximately 24 separate industry groups. That definition comes from the underlying ETF, the SPY. Okay, I got that right from their website. So more importantly, it's a cap-weighted index, which means that larger companies are held in greater amounts. As you can see from over here, we have Apple and Microsoft, and together they're roughly 12% or so of this index when I took the screenshot. Okay, so we have to know that because major moves in either one of these names or both of them together in one direction or the other can bully this this index around, and it's going to make a difference in the price that we see, right? So what am I actually looking for when I look at this chart? Okay, and I think this is real important here. I'm looking at price, obviously, but I'm also, and by the way, that price needs to be tight and organized, right? Not wide and loose. I'm not looking for erratic. I'm looking for a nice, tight price action. It should be making higher highs and higher lows, right? That's the definition of an uptrend. I'm also looking at the moving averages, and I use them to help me define the trend more than anything else. And I ask myself, are they stacked in a bullish way, moving from the bottom left to the top right, or a bearish way, right? Now you'll see 4 moving averages on here. So the green line is a 9-day EMA. The orange line is the 23-day EMA. The blue line is the 50-day SMA, and the red line is the 200-day SMA. And, whether you use the 9-day EMA or the 10-day or the 11-day, it's giving you roughly the same thing. Same thing for my, 21 or 23 or 22. It's going to be in the same idea. And again, I'm looking for, is the 9-day stacked over the 23 and 23 over the 50 and 50 over the 200? And that is my bullish, trend alignment or not? Or are they bearishly aligned? So let's take a look at this chart for just a moment, okay? So in this example, you could see how price action ripped through the moving averages. You see how they're starting to get bearishly aligned, fell below the 200-day. And what are we seeing here? We're seeing this wide and loose price action. It's kind of going sideways, but just really wide and loose and gross price action here, right? Now, as price comes back up, it's still not great, but it's starting to get above the moving averages. They're starting to align. You see, it got rejected up here. But now, as it comes back and tests the 200-day moving average again for the 1, 2, 3rd time, we'll say, you see how price action is starting to tighten up. It's starting to, the moving averages are starting to align. It's getting above the 200-day. And look at this beautiful tight price action over here, right? This is what I'm looking for charts to look like as much as possible. This is the type of action that I'd like to make my money in right here. This right here, for me at least, that's a very hard environment for me to trade. That's an environment that I'm probably losing money in if I'm putting on too heavy trades. But this is what I'm looking for right there. Now, I'm always looking at daily and weekly charts as well. because I believe that you need to understand the structure of the market, and that kind of weekly charts and longer term timeframes give you that. You got to know where you came from, right? Where's the overhead supply going to be? Now, because cap weighted indexes can be bullied around, I'm also looking at the equal weight index. I'm using RSP for my equal weighted SPX index. And as you can see here, just a beautiful equal weighting right there. So again, nobody's bullying anybody around, but it's got basically the same makeup, and it's nice to see the two of them. Also, sometimes I like to look at them relative to each other, because if I see the RSP is actually, outperforming the SPX, that's a lot of information. That tells me that we have a nice broad-based move in the market, right? If I'm seeing the SPX outperforming RSP, I may need to dig a little deeper and see, are we just seeing the mega caps and very large cap names holding the market up, while underneath we're seeing deterioration? So that's another way that I like to use cap weighted versus equal weight indexes. All right, so I do the same thing for the Qs. Right here you can see Apple is Apple, Microsoft, Amazon, Tesla, huge weightings. Even put in Google in there. That's roughly 40% or so of the NASDAQ are these 5 holdings, right? Pretty crazy, but that's what it is. So we have to know this, right? And we have to know, again, who's holding it up and who's going to bully around the markets. Looking at the equal weights, again, just so you guys can see how much difference it looks than the weighted. Okay, again, always look at the both of them together. Next up, mid caps, MDY, IWM, small cap, IWO, small cap growth. Now, all of these are already equal weighted, so I don't have to do anything else compared to that. All right. So let's take a moment and talk about small caps, IWM, and even more importantly, the small cap growth, IWO. And we're going to talk to these about as a measure of risk appetite, right? Risk on or risk off. Because remember, like IWO, which is small cap growth names only, they're smaller, they're more speculative, they have less liquidity, right? And so the idea is, if people are willing to buy these names, then we could be, in a risk on environment. And they're being sold, then we potentially could be in a risk off environment. So like right now, I'm watching to see is IWO, when that starts to stabilize and lead the market higher, that may be a really nice indication that the market has actually turned, right? Because again, it may be a risk on indicator.